Good afternoon, everybody. This afternoon, the time we have together, we're going to talk about the true cost of an hour of labor. And before we get started, the first thing that we have to put out there is a disclaimer. Okay, the numbers we're going to be talking about today are sample figures. Okay, it's against the law. The Federal Trade Commission frowns on groups gathering and setting the prices for whatever their products or services are. So we're more interested in the methodology and how you do the calculations rather than the actual numbers. So all the numbers you see today were just samples for purposes of doing our calculations and going through the process of calculating the true cost for an hour of labor. So this afternoon we're going to talk about what's included in the selling price for labor. Okay, that obviously includes labor costs, but what exactly does that mean? We'll touch on what overhead costs are, and then we'll discuss briefly the concept of a billable hour in order to come up with a break-even cost for our labor. And then we'll talk about profits in the industry and that we sell. So where we're going to start out is we're going to make this assumption that we're paying the plumber $25 an hourly wage. I understand there's a lot of different pay plans out there, performance pay, all those kind of things, but to keep it simple, we're just going to go with a $25 hourly wage, and we're going to talk about a small company that has 3 plumbers in the field. So if you are making $25 an hour and you work a 40-hour week, your pay stub will look something like this, right? Worked 40 hours, hourly rate of 25, you worked 40 hours, so your gross pay is $1,000, and so when you look at your check that you get from your employer, it says $1,000 on it, right? No, it's not true, right? There's taxes and deductions. You always wondered what FICA meant, who was this Medicare person, those kind of things. Well, those are taxes that have to be withheld from your paycheck in order to pay the taxes that you're making on the income. Your pay stub is going to look something more like this, where you have your hourly rate still at $25 an hour, and you work the 40 hours, so your gross pay is in fact still the $1,000, but now you have taxes deducted. You know, Social Security tax, Medicare tax, federal income tax, state income tax. If you have city taxes like we do here in Ohio, and I know New York and California do, then you're going to have a city tax line as well. But you subtract all those taxes that you have withheld from that $1,000, and so your check isn't $1,000 when you get it. It's more like $573.50 in this example. So let's talk about labor costs. You're making $25 an hour, or you're paying somebody $25 an hour, and you as the employee have the federal withholding, the Social Security and Medicare that we just talked about. Well, with Social Security and Medicare, the employer also has a component that they have to pay. They have to match. So to pay you $25, it's really going to cost the company more than $25 for you to get that $25. Here are some of the things that the company has to pay from a tax standpoint. Like I mentioned, they have to match the Social Security and Medicare tax. So Social Security tax is 6.2% up to the wage limit for this year, which is $113,700. So any wages you make that total up to $113,700, the company is going to have to pay 6.2% Social Security tax. The Medicare tax is the other portion. That's the 1.45% tax component. And that there's no wage limit on that. So you're going to pay 1.45% whether you make $100 or $1 million. And by the same token, the company has to match that. So if you're making $200,000, then you pay the 1.45% on that, and the company, the employer, has to pay that exact same amount. Unemployment taxes. It'd be nice to think that the job market out there is great and everybody's gainfully employed, but we know that's not always the case, and so we have unemployment taxes that the company has to pay. You'll never see unemployment tax deducted on your paycheck or your pay stub because it's an employer or company paid tax. And almost every state that I'm aware of has unemployment tax, so you pay it at the federal level and you pay it at the state level. Each state has a different percent that the unemployment tax is and a different wage limit that they have. And as we get a little bit farther into the program here and work through a sample, I'll point that out and I'll show you what I've come up with for purposes of our discussion this afternoon. So you have a federal limit and you have a state limit for unemployment taxes that the company is mandated to pay. Those are experience rated, by the way. So if you're a company that lays a lot of people off, in almost every state that I'm aware of, it's based on your experience. So if you're laying a lot of people off, your unemployment tax rate is going to be higher. If you don't lay people off, then you're going to have a much lower rate for your unemployment tax. That same holds true for workers' compensation. Again, the laws in each state are different. When we get to the sample, I'll mention that there, but you know, in our industry especially, my experience in my own family, my own family's business, a lot of backs, a lot of knees, shoulders. My brother's dealing with a shoulder issue right now, so that's from working in the field underneath a kitchen sink or, you know, in a commercial building. Injuries are going to happen, so the company has to pay into workers' compensation fund, or if you're in a state where workers' compensation is private, then you're just going to go through somebody like Federated Insurance and you're going to have your own insurance policy, private insurance policy. Here in Ohio, we pay into a public system, and we're one of a few states that does it that way. But so these are all components, taxes that the company has to pay while they're paying you that $25 per hour, the hourly wage. Now, it's just not the taxes that have to be included and added to that $25 an hour, because hopefully all the companies or the company that you're working for has good benefits, or at least a decent benefits package. And on the screen here now you see a number of the typical employee benefits that are given throughout the country. So health insurance, and there's a big discussion going on that right now with the health insurance exchanges just being rolled out yesterday. Life insurance, vision and dental insurance, retirement plan contributions, and some people also provide company vehicles for their employees, which is also a benefit that is taxable. So besides the employer taxes, we also have to figure in all these benefit costs to that $25 an hour. So let's take a look at this. As Wayne said at the beginning, you know, you'll have access to the slides, so you'll be able to get a copy of this. There's a lot of numbers here. If you need to make your screen a little bit bigger and you can do that, certainly do that. But what I've got here is we're going to take that $25 an hour that we're paying, and a standard work year is 2,080 hours. So if you worked 40 hours a week for 52 weeks of the year, that would total to $52,000 in wages based on $25 an hour. We're not considering overtime. We're just looking at the standard work year. Well, the company has to, as I said, they have to pay the Social Security and Medicare tax just like we do as the employee. So for this plumber to make $25 an hour, we have to pay $3,224 in Social Security tax for the company, and the Medicare tax is $754. Those are the employer matches. Then we have to pay the federal and state unemployment. Now the federal unemployment is you pay 0.8% on the first $7,000 you earn. So the company pays that, not the employee. So the first $7,000 that we pay this plumber, 0.8% works out to $56. So for the year, we have to pay $56 to the federal government for federal unemployment. At the state level, as I mentioned, it varies from state to state. There are, for purposes of our sample, I'm using just over 15,000. I would say that's somewhere about the middle of the pack across the country from the wage limits that I saw for unemployment taxes. And I did the same thing with the tax rate. I'm using 4%. So 4% of the first $15,400 the company pays this plumber works out to $616. So on top of paying the plumber $25 an hour, $52,000 for the year, Social Security and Medicare taxes, now we have to pay $616 to whatever state you're in. So state of Ohio, Texas, Wisconsin, what have you, you pay into the state unemployment compensation fund. Now we have to take into effect, we also have to include workers' compensation. Again, this is rated based on your company's experience. So if my family business has a good, we have few injuries, our workers' comp rates are going to be much better than a company that's got a lot of injuries or paying out a lot of claims. Essentially, it's exactly like insurance if you think about it. So, and so each company's got a different rating. Each state rates their the plumbing, heating, cooling industry experience rating differently. I came up with 5%, which is a realistic percentage that I've seen out there across the country for unemployment compensation, or excuse me, workers' compensation insurance. So in order to figure out what that works out to, the company has to pay at 5%. We're going to multiply that 5% by the $52,000 in wages for the plumber for the year, that $25 an hour, and that works out to $2,600. So for the year, we have to spend as a company $2,600 just to cover that workers' compensation premium for that plumber. So now we've covered the taxes, and now we get into benefits. And so for purposes of today's program and to keep things kind of simple, I've just included health insurance and life insurance at $750 a month. It could be higher or lower for each of you specifically in your companies or the companies that you work for. A little bit for vision and dental, $50 a month, which works out to $600 a year. And then I went really I went conservatively here on the retirement plan, but I think it's important to at least have it here. Too many companies don't have any kind of retirement plan set up, and I'll just put this out there that if you don't have some kind of retirement plan for yourself or your own company, you really seriously need to look at setting one up, because it's important to look out for your own future, and you want to be an employer of choice. The companies that are providing the best benefits tend to draw the best people. So I went with a small contribution rate here just to keep things fairly simple. 3%, the company is going to put 3% of the plumber's wages into a retirement plan account. So 3% of that $52,000 is $1,560. So when you add the taxes that we have to pay as a company, and then you add the insurance, the benefits that we're paying to the plumber, to pay that plumber $52,000 a year, which is $25 an hour, it's going to cost us $70,410. Now, as you can see at the bottom there, I broke it down to an hourly basis. So to pay the plumber $25 an hour, so if you're an employee and you're making $25 an hour, it is costing the company $33.85 to pay you that $25 per hour. And I put it a little bit more graphically here on this next slide. So in this case, in this scenario, you've got an additional $8.85 per hour in taxes and benefits costs that the company has to pay in order to pay the $25 an hour to the plumber. That's only one half of the labor cost. Figure out what the cost of the company is, true cost of the company for that hour of labor. So there's this other aspect of it is called overhead. And overhead is a term that's often misconstrued by a lot of contractors especially. They have a hard time defining it, but they have they're usually fairly adept at giving examples of overhead. But overhead costs to support the company's functioning. And it's not noted here on the slide. Those of you that have been through the Understanding Overhead program that the Foundation has put on or have seen those materials, we are a firm believer that you need to cover all of your overhead costs in the labor component of what you do. And that's simply because our primary product that we sell to our clients is our skills, our workmanship, our labor. With the advent, especially in the last 10 years, of the Home Depots, the Lowe's, all the home improvement stores, it's getting harder and harder to apply some of your overhead to that material, so to the garbage disposal or whatever, when the homeowners are often calling and saying they already have the water heater or they already have the garbage disposal and they just like us to come out and install it. So for that reason, I am a firm believer that you should recover all of your overhead costs within the labor component. That's how we're set up to do it exactly here. So, definition of overhead, okay? It's the costs that you can't assign to any specific job. They're costs that you need to run the business, okay? Keep the business running. And in many cases, you're going to incur them whether or not you sell the job, whether or not you make a sale. Now we're going to take a look at some specific overhead costs. One of the ways I like to do it is I'm working through, and for those of you that are plumbers out there, okay, you work in the field and you don't maybe have the office or the business background, is I kind of try to do it with building blocks. So we talked about paying a $25 an hour wage, and we talked about the benefits that go with that. Okay, so we have a plumber in our company that's all set to go. We've hired a plumber. He's qualified, experienced. Now, what else do we need to give him as far as tools, etc., so he can go out and perform his services? So here on this screen are a few of the first basic items, and virtually all of these relate to the plumber himself. It's going to be difficult to get out to the homeowners, to the residents to replace the water heater without transportation. So you have to have a vehicle. I threw a picture of one of our vehicles up there. But so you have to have a way for the plumber to get to the house. Well, you have the vehicle expense. So you have the cost of the vehicle or a lease payment. You have to figure that into your overhead, okay? Because somebody has to pay for that vehicle. You know, we have to recover the cost of using that vehicle for like wear and tear, those kind of things. So in order to get the plumber to the house, we have a vehicle. What's one of the biggest expenses we have as a contractor besides the labor itself? fuel costs. So we have to put fuel into the truck that we're now providing for the plumber. You also have to have insurance because I know Federated Insurance is a great partner of the PHCC, and we actually use them and have a good relationship with them. You have to have insurance for the vehicle. In case there's an accident, you have to have proper coverage. So insurance is something else that's an overhead item that we have to factor in. Education and training for plumbers, whether it's continuing education or sending them in to, this is a copy of the Plumbing 401 manual that the PHCC has. If you're putting an apprentice through the 4 years of schooling, that's a cost that the business incurs that we can't specifically charge to a job, but that we have to recover within the labor component. So you have to send trained people out, and or you have to continue to train them. If you are doing residential service and you're a COD company, which hopefully you are, you've got credit card fees. The 2 to 2.5 to 3%, depending on which credit cards you use. Those fees we incur as contractors in a business that we have to recoup from everybody. Cell phones, smartphones, if you want to have a laptop computer, some companies I know use iPads, those kind of things. That's a whole other component to getting the guy out to the house to do the work. That is overhead that we have to cover. And of course then you have tools like video camera system here and tools. The truck's got to have tools on it. And whether you go out and buy all the tools at once and then figure an amount that you're going to charge within your overhead to everybody to recoup the cost of those tools, or if you already have your own tools and equipment and then you're going to charge an ongoing fee. Either way, you have to figure that as a component of the overhead, because we can't go, think about this, those of you that do drain cleaning, and you go and you snake a drain and you get the snake stuck, you got a blockage. So you throw the video camera system in there and you find a break in the line. You don't walk into Mrs. Smith and say, Mrs. Smith, I have some bad news, and say, yeah, I found a break in your sewer line. Oh my God, that's terrible. Well, I have some worse news. Well, what's that? Well, it's your lucky day. This video camera equipment cost me $6 or $7 grand, and since I'm here at your house, you owe me $6 or $7 grand for the video system. Completely outrageous statement, I know. The reason I'm making that is to reinforce the point. That's why you have to recoup the cost of, say, the video camera system over all your clients, all the work that you do. Okay, let me check and see if we have questions so far. Okay, so far so good. Now here's a whole other group of overhead items. I couldn't find a good picture that would get across the point of owner salary, so I just put it in big green letters at the top. Those of you that heard me speak before know that I am insistent the #1 overhead item in your company, in any company, is the owner's salary. That's the very first thing you have to figure in to your overhead calculation, because you have to pay yourself. Otherwise, why go into business for yourself? Go to work for somebody else. Well, you'll make a good wage and you won't have to deal with all the stress. Those of you that are in attendance today that aren't owners, that maybe are managers or field technicians or plumbers or HVAC guys, the boss has to make a living too, just like we do as plumbers. So if you're making $25 an hour and you're working at least the standard work year of 2,080 hours, or getting paid for those 2,080 hours when you factor in holidays and vacation in that, the boss or the owner has every right to make at least that much, if not more, and I insist a lot more. But we have to cover the owner's salary as well, and again, the way we do that is through overhead. Some of the other overhead expenses we have, getting outdated, but you still have the yellow pages out there. You have rent. You could be renting a shop or a building or office space that you have to figure into overhead. For those of you that work out of your house and say, oh, I don't have rent because I work out of my house or I work out of my garage. You do still have rent. You're just not paying it to a third party, a real estate company or a landlord or something. You're using up your house. You're taking up space in your garage. So you still are incurring a rental expense. Now, is it $1,200 a month or $2,000 a month like you'd be paying, depending on what city you're in, to a landlord? No, of course not. But just because you work out of your own house or your garage, don't think that you don't have to account for some kind of rent expense. Same thing with utilities. Utilities we have to cover in our business. Same thing if you're using your house, your garage, you're using electricity, the phone lines, those kind of things. They might not be as costly as having a separate location, but you still have to figure those items into your overhead. And then you have office equipment, like computer systems, software, things like that. Here, this is the picture of the GoDaddy hood is for two reasons. One, you have some kind of internet presence, right? Website. If you don't, you should. That's marketing expense. That cost, that's part of overhead. You could be using vehicle wraps. It's a whole other aspect of your marketing. But all, website, social media, vehicle wrapping, newsletters, which I have down here in the corner, all those kind of marketing expenses are overhead and must be recouped through all of the work that you do. Postage is another obvious one, a big one. The one right in the middle, obviously, is extremely important. Your PHCC, and if you're a QSC member, your QSC dues. All the customers pay for our membership in that. Again, we don't just go out to Mrs. Smith or Mr. Jones and hand them the PHCC bill. No, we charge a little bit over all our client base to recoup our dues investment because it's part of our overhead. And then when you have vehicles, you're bound to have repairs and maintenance for them as well. So this is another grouping of overhead items. Here's a basic list of just some of the overhead items I talked about. You've got owner's salaries, administrative salaries, advertising, promotional expenses, PHCC dues, commercial insurance, and on and on. What I'd like to take a second and do is bring up on the screen and show you the overhead screen. This is part of the overhead and profit calculator that the PHCC Educational Foundation has put together and is available to members. But I just want to show you how long and detailed this list is. So it's very well thought out. Let me take it to the top. So you got advertising and marketing. But let's get more specific. So you've got newspapers. You've got TV and radio, sponsorships, yellow pages, website. I know there's a tendency for the accountants, CPAs, and bookkeepers. I am especially fit that bill about detail-oriented. I don't want you to get overwhelmed with the details, but I want you to get enough of the details that will help you make an educated business decision. And what I'm referring to there is, let me go to this next slide here. Now, this is a sample overhead, total overhead expenses for the sample company with 3 plumbers. And you can see I've just got one line item here for marketing for $20,700. Office expenses, $36.42, just one line item. And the reason I'm showing it on this screen is for space. Simply there's not enough room on the slide to get into specific detail. But this isn't what your overhead report should look like within your company. It needs to look more like this. Okay? You need to have a lot of detail. And let me give you a perfect example of this. I use this one all the time because most all of us can relate to this. I just have to get down to that section. Okay. Vehicle and equipment expenses. If you look on the slide here, we've got vehicles expenses of $19,500. Okay? That doesn't give us a lot of detail. On the detailed overhead costs, it's broken down into, okay, you know, we've got vehicle leases, we've got GPS tracking that we have on our vehicles, but what's the biggest expense that I said we have overhead-wise? One of the biggest costs of the company, vehicle fuel, right? What's the cost of diesel and gasoline done over the last 5 years especially? Significantly jumped, right? If you don't have any detail in your income statement and in your overhead report, how are you going to be able to monitor your fuel? Like all of a sudden gas goes up 75 cents, you know, within a week. That's going to have a significant impact on our company's financial operations. It's certainly going to impact our cost of doing business. That's why the detail is important. So I'm not showing it here on the slide for space limitation reasons, but I wanted to show you the Excel program that the foundation has and that gets very specific into the overhead detail items, and it also gives you places where if you have overhead items in your own company that maybe aren't on the list, you can add them there. So your overhead's a lot more detailed than what you see on the screen here for purposes of our sample company. So for a second, we're going to set aside the overhead costs, and we're going to talk about concept of billable time and billable hours. And I know there's a lot of different companies out there doing billing differently, time and material, flat rate, by the job, a bunch of different methods. But the main thing, as I said earlier, that we have to sell are billable hours. So what's considered billable time? The billable time is the time that we are actually installing the toilets, snaking the drains, replacing the water heaters. You're doing actual work on the job. You're doing the actual plumbing work or the actual home comfort work. That is billable time. The rest of the time, the driving to and from the job, the webinars that you may be attending, the office meetings that you go to, the safety training you go to, the supply trips to the supply house to pick up materials, your holiday time, vacation time, all that time is non-billable time. It can't be tied directly to the work that we're doing. It can't be tied to the actual plumbing work or the actual home comfort work. But we have to recoup that time. Just because we can't, in most cases, directly bill for it, we have to recover it. Now, the one side note I will say on that is, you know, a lot of T&M contractors, time and material contractors, will tell me, oh, I'm covered. You know, I get paid for every minute my guy works. You know, we charge portal to portal. We charge by the hour. You know, for time, we just charge by the hour. So it takes me a half an hour to get Mrs. Smith's. She's paying for that half hour, and then the clock continues to run till we're finished with the work. Well, it's a very rare case where I've truly seen a T&M contractor that's been willing to share with me, confidentially, of course, where he or she is actually at 100% billable. You know, where they're actually recouping every single minute of time. So we have segments of time that are directly attributable to the job, like installing the water heater, like I said, and then there's times that aren't directly related to that job. But just because they're not directly related to that job doesn't mean we don't have to recover those costs. Because think about it, those of you that are the technicians out there, the plumbers, comfort people, even the managers, you agreed to work, you know, you were hired at $25 an hour in this sample company. how would you feel if the business owner said, well, okay, I'm just going to pay you for the time that you're actually installing the water heater or snaking the drain. So you really don't end up making $25 an hour. It might be something like 12 or 14. No fair, right? Well, you get paid for all your time. The company has to recoup all the time that you get paid for, billable and non-billable. So for purposes of our sample company today, what you see on the screen now holds true specifically for residential service and repair contractors. Let me explain what I mean by that. I mentioned earlier, a standard work year is 52 weeks a year, 40 hours a week. That works out to 2,080 hours in a standard work year. We're not going to factor in or address overtime because there's no guarantee for overtime. The last few years, a lot of companies haven't been able to guarantee or commit to anywhere near even 40 hours a week. So we're not going to consider overtime hours into our equation here. So 52 weeks, 40 hours a week, 2,080 hours. But we all need time to recharge our batteries, right? I don't know of anybody that works, 52 days a year, 40 hours a week. You've got to take your holidays, your vacation. You need your recharge time, your downtime. As I mentioned before, you get those holiday hours and the vacation time. And in this example, I've just selected the 6 major holidays and then 2 weeks vacation. Those hours are hours that we pay, the company pays to the plumber, the guy making $25 an hour, but the company's got no revenue coming in. But the company's got to recoup those hours that they're paying you the $25 an hour when you're not working. So the math there is pretty straightforward. You have 6 holidays times 8 hours a day. It's 48 hours. 2 weeks vacation, which is 10 days, 8 hours a day. That works out to be 80 hours that we have to subtract. And then I threw in a few other days off. A lot of companies give their employees their birthdays off, their anniversaries, those kind of things. So I threw in 3 other paid days off. So 3 days times 8 hours is 24 hours of time off that we get paid for as an employee, but that the company doesn't have money coming in. So we have to take those hours out of the standard work year. Okay, so we pull those hours out of the 2,080, and that leaves us with 1,928 hours the course of the year. These are the hours left in the year, based on this example, that we are available to work in a standard work year. Now, I mentioned earlier that this is a residential service and repair company. And the reason I say that this example is a residential service and repair company, because the billable time in a service and repair company is significantly different than a company that does commercial new construction, or if for some reason you do all or mostly new residential construction. The billable percentage of time, the time you're actually on the job doing the work, is completely different. Think about it. If you're a commercial plumber, you're working on, you guys are putting up a new factory, so what do? In the morning, you may report to the shop to get a company truck, or you may go right to the job site. You're out on site. You start to work. You're there till the end of the day, short of taking your lunch break and your breaks, and then you go home. Well, from the company's perspective, how much of that 8-hour day was billable? A significant amount of it, right? Maybe almost 8 hours, possibly. So 8 hours divided by 8 hours is 100% billable. That's pretty significant. If you're doing service and repair, residential service and repair, especially if you're in a larger city, we're in the southeast suburbs of Cleveland, our average drive time between calls could be 15 minutes to upwards of 45 minutes. So if you've got 3 service calls that day and you're having to drive, they're 3 different towns, you're not actually snaking the drain or actually installing the piping or replacing the water heater as much time. You have more downtime, so to speak. You have more travel time. That's less billable time. So for purposes of this example today, we're focusing on residential service and repair. So 50% billable percentage. How did I come up with that? Well, honestly, it's a starting point that I recommend to residential service and repair contractors if they have no idea what their billable or productivity percentage is. I set them up right then and there on a path to start tracking it so we can find out actually what it is. But in determining what their actual labor break-even cost is with overhead and to come up with a selling price for that labor without any other information, I tell them to start at 50%. And then as we start tracking what the actual percentage is, we'll go back and redo the calculations as needed. So if we're a residential service and repair company, for each plumber, and we've got 1,928 hours that are available to bill, and we're billable or productive half the time, 50% of that is 964 projected billable hours for that plumber. So now we come to the point where we pull the labor and the overhead components back together. And we're going to come up with a break-even price for our labor. So you can see here the question, what's our break-even price per billable hour? Labor component, overhead component, and then our, add that up, and that's going to be our break-even component. Okay, so if you remember a number of slides ago, when we took the $25 an hour that we're paying the plumber, and then we had to add in the company employer taxes, you know, Social Security, Medicare, unemployment, workers' comp, then you had to have the benefits in, and when we finished, we came up with $33.85. So it was costing us, or in annual dollars, to pay a plumber $52,000 a year, which is $25 an hour. It cost us, the company, $70,410. We divide that total amount of the cost of our labor cost for that plumber by the billable hours that that plumber is going to have that year. So residential service and repair came out to 964 hours. You divide that and your end result is $73.04. That is the direct labor cost per billable hour. What does that mean? Okay, that means just from the labor standpoint, okay, from the labor cost the company incurs, the employer taxes, the company taxes, and the company benefits, and the company's billable efficiency rating, in order to pay a plumber $25 in that scenario, it is costing the company $73.04 to pay that plumber $25 an hour plus the benefits received. Now in that short period of time with that calculation, we almost we were almost triple, right? $25, that's almost 3 times the $25. And we're not done yet. That's only the labor part. Now we've got to go back and address the overhead. So for this company, is a 3-plumber company, remember what I said. If we go back to that slide where I had the overhead summary, and let me do that really quick. So here, our sample company with 3 plumbers, our total overhead expenses for this company is just over $250,000. So, you know, $254,737. The total overhead expenses for the sample company, okay? So we bring that number forward. Now we need it on a billable hour basis. We have to break it down. So we divide the total overhead cost for the company by the billable hours. Now, where did this 2,892 number come from? If you remember, I said there's 3 plumbers in the company, and each of them had 964 hours. So if you multiply 964 times 3, you'll get 2,892 hours billable. So when you do that division, divide the overhead by those hours, it comes out to $88.08. So the overhead component of the labor for this company, the sample company, is $88. And that's over 3 times the $25 an hour that we're paying the plumber. So that's pretty significant. But that's not even our break even. Now we have to put it together. So we take the $73.04 that we figured for our actual labor costs, figure in the overhead component, which is $88.08, and you're left with a break even of $161.12 per billable hour. So for every hour this company bills out, based on these numbers, it needs to bring in $161.12 just to break even. That doesn't include any profit at all. And I know seeing this number for a lot of you is a shock, saying, oh my God, I know there's people, companies in my area that charge less than half that. And there probably are. But that's, we'll talk about next webinar, we'll talk about more how to address that. But so now we need to figure in profit, right? Nobody's in business just to make a wage. If you're a business owner, you're in to make a profit besides the salary or benefits you take. So here are some profit goals from, or excuse me, profit goals. Here's some profit margins from some companies and logos that look awful familiar. Happiest place on earth. You know why they're so happy? As a shareholder, I'll tell you why I'm happy, because 12 cents out of every dollar that comes through that park is profit. You know, so for those of you that take kids and grandkids or nieces and nephews, wonderful place, but you pay for the experience. McDonald's, 20%. 20 cents of every dollar goes right to the bottom line. Remember the dollar menu they have? Do you notice how everything on the dollar menu isn't exactly $1 anymore? It's like $1.40 or whatever, so they're playing games with that. But okay, so what's the profit industry in our industry, the PHC industry? What's the average profit margin been? Unfortunately, and this is this year's data according to the research I've done through ProfitSense. Across the nation, the average PHC profit percentage is 3.83%, less than 4%. Before taxes. So not even 4%, and that's before taxes. The good aspect of this is those of you that have been through any of my programs before, or we talked before, know that, you know, geez, even a couple years ago, Frank Blau was still talking, you know, it's less than 3 cents. We've moved up from about 2 3/4 to 3.1% up to almost 4%. So the nice thing is the message is getting out there and we are trending positive. So that's encouraging. Now, I kind of alluded to this earlier when I said that we're a service and repair company for this sample. Service and repair focused companies, okay, tend to have a higher profit percentage on a lower volume of sales. Because would you agree, if you're going to install a water heater and the water heater installation is, I don't know, $1,000, $1,500, that sale is significantly different than installing the plumbing in a new factory that's $350,000, right? Construction-focused companies tend to have a much higher volume of sales, but a much lower profit percentage. So just remember that. Now, we're getting a little bit short on time, and I apologize for that, but we've got to go through the profit, calculating a profit on that $161.12 that we figured out it costs us to operate the company to pay the plumbers $25 an hour plus the benefits. Two methods, markup versus margin. Markup method is the old method. It's the way we were always taught, and frankly, it's wrong. And I'm going to show you why right now. If we decide our company profit goal is 15%, which I don't know about you guys, but I think that's reasonable. I mean, heck, we're not even 4% right now average as an industry. Let's shoot. What happens if we shoot 15%, but we don't get there? We don't get close. If we got 10%, that's still twice as high, more than twice as high as we are now, right? From a profit percentage goal. So here's what's wrong with the calculation. So we have a job cost. A job is $1,000 worth of cost in it. We want to make 15% profit. So the traditional calculation is you take 1,000 times the 15%, and that gives you $150. Okay, so $1,000 in job cost plus $150 in profit equals $1,150 of the job selling price. Well, one thing I learned going back to 9th grade math in high school is all math equations can be proven, and then if they can't be proven, then it must not be true. So we're going to double check our math here and make sure we're right. So how do we do that? Well, we have the profit amount that we calculated of $150. We're going to divide that by the job selling price, right? Profit divided by selling price is going to equal our profit percentage. And as long as we did the calculation right, we're going to be all set. So our goal was 15%. We've got $150 in profit divided by the selling price of $11.50, and obviously, it's not 15%. You can see it's a fail. It's only 13.04%. Well, what happened to that other almost 2%? It just vanished into thin air because the markup method is based on costs rather than the selling price. It's based on the cost. You know who loves this method? For those of you that do not know, who would love this method? Builders, developers, homeowners, business people. Why? Because in this scenario, they end up paying us less. You know, we think we're going to shoot, we think we've got a 15% profit margin figured in, and we're only at 13%. So let's look at the right way to do it. That's the margin method. And I think thankfully, because of the work of the PHCC and QSC and a number of consultants out there over the last handful of years, we've gotten a lot better with this, and that's why you're seeing that profit margin for the industry up towards 4%. It's the margin method. The margin method is based on the selling price. So here we go again. Our profit goal is still 15%. Now, if our profit goal is 15%, what is the rest of the selling price? That other component is our job cost, right? So like think about a pizza pie. You have 100%, you have a whole pie. If 15% of that pie is going to be the profit, the rest of that pie is going to be the job cost. Well, that job cost percentage is 85%. 100% minus the 15% profit goal is equal to 85%. So again, we have $1,000 in job costs. Now watch what we do here. Instead of multiplying, we take that $1,000 and we divide it by the 85%, the 100% of the pie minus the profit percentage. Okay? Because if you think about it, I said 85% is the job cost. So our job cost is $1,000, right? So 85% of our selling price is $1,000. To get the whole selling price, we have to divide that 1,000 by that 85%. When you do that, you come up with a selling price of $1,176 and some change. So that's our new selling price. Okay, so what's our profit on that? Well, our selling price we've just calculated is $1,176 and change. Subtract out the job cost. That leaves us a profit amount of $176.47. Well, let's prove it. Let's make sure that our calculation is right. We're shooting for a 15% profit goal, so let's see where we are. So we take the profit dollars, that $176.47, and we divide it by the selling price. Profit divided by the selling price is going to give us our profit percentage. Well, what do you know? Under this method, we get the 15%. You take 176.47 divided by 1176.47, you come up with 15%. That's what we shot for. That means this is correct. So pricing this job to get 15%, we're going to price it out at 1176.47. Now I'm going to pause for a second and look. Does anybody have questions on this specific calculation here, what I just did? Wayne, if you see anything, let me know. I'm taking a quick look. I don't see anything yet.
Okay. Just as a reminder to our members, if you want to type in a question, it should be on the lower right-hand side of your screen. There should be a box that says questions.
This is a crucial part of our conversation today, because this is what most contractors miss. So, and again, you'll have access to these slides, so you can go over these. You can go over these calculations again at a later time. But the markup method, that's why the markup method is wrong. The margin method's the right way to do it. So let's take a couple minutes here. We only have a few minutes left, but let's take the time and figure that out. So, what's the big deal? Why do I care if I do it markup versus margin? Well, if we have $1,000 in job costs and we just went through this exercise, the difference, it's only $26.47. What's the big deal? Well, what if that was $1 million? Okay, so you calculate all throughout the year. You've got $1 million in sales instead of $1,000 job. That difference grows to $61,000, almost $500. So we shorted ourselves $61,500. Now look at this note at the bottom. To make up that difference, our sample company, using this method, we would need to sell an additional almost $410,000 to make up the lost profits. So look how quickly we turn $26,500 to $61,500 to, nearly $500,000. So let's take a look now at our sample company. Remember, we had the break even, paying a plumber $25 an hour plus the benefits, plus the owner's salary and all the other overhead we had. Our break even at 50% efficiency is $161.12. So what's our profit goal going to be for the sample company? 10%, 15, 20, 25? Here are the selling price amounts that we come to for that billable hour labor. So if we want to make 10%, we take the $161.12 and divide it by 0.9. That gives us $179 a billable hour. And onward, up all the way up to 25%. So if you want to make 25% at our break even, you're going to have to sell your billable labor at $215 per billable hour. Significant amount, I know. Those of you that have concerns about this, fears, my contact information is at the end, and I'm always available to talk to you on the phone or chat online. There's companies all over the country getting the amounts they need using the proper methods, getting in excess of $200 per billed hour for their services. So if everything goes right, we do everything right, and everything comes in as we just figured out, before taxes, per billable hour, the owner is going to get about 26 bucks at 10%. And if it's higher, if it's a higher percentage at 25%, it's almost $54 per billed hour. I like the 54 a lot more than I like the 26. Remember, folks, that's before taxes, though. Uncle Sam and the state and the city and whoever else hasn't gotten their hands on their cut yet. So for those of you that think, the owner's got a money tree sitting in his office that he's hiding, or a vault in his office, that's not true. There's not a printing machine in there. paying somebody $25 an hour and paying the owner a salary and the other overhead items and making making 10% profit before taxes, the owner will make $26 approximately for every hour billed out. So now, get back to the good. My customers are never going to pay blank, whatever you come up with, that 214, 180, what have you, okay? And John Zink makes a great point on this slide, and I want to read it to you, okay? If you calculate everything that reflects your own company's costs, okay, and you decide to charge less than that amount, so like we just came up with the 161, okay, for our break even. If we decide to charge less than that, we're choosing to put our own company out of business, and we're choosing to impact our employees, laying them off, stealing from the vendors you owe money to, and defaulting on loans that you've guaranteed to the bank and other people, okay? Cash flow only goes so long, only goes so far. So what do we do about it? Well, selling your proper labor rate for a billable hour, it's all about how you promote, how you approach the customer, how you talk to the customer, what you do. And that's a great lead into next week's program, which is going to be talking about, okay, I know what my true cost of labor for a billable hour is now. I know what I need to charge. How do I get that? Next week's webinar is going to talk to you about the basics of flat rate pricing and that whole area of business. So if you're not familiar with that, I would encourage you to attend. If you are familiar and you'd like a refresher or an update, I would encourage you to join us next Wednesday at the same time. With that, I'm going to open it up to questions. I'll bring this back over to see if there are any questions. I don't see anything, so I'm going to switch to this last slide, and I'm going to change. Well, I'm going to leave that up for a minute. Wayne, before I switch the screen back over to you, I want to leave my contact information up there for a second.